Part 3 of options, derivatives, and dealer delta hedging. Let's finish this one off strong. We are going to discuss open interest and how it affects the options chain on both the call and put side. We are going to discuss the most 3 overcrowded trades since the October 2022 low, which allowed the market via dealer delta hedging mechanics to be pushed up into our January 2025 top during Trump's inauguration, and now currently where we're trading in December at that 685 level on the S&P 500. The 3 most overcrowded trades I want to talk to you guys about is 1, the call buying and put writing on the Mag 7. They're combining right now for over 40% of the market cap of the S&P in total. If these stocks move, they're going to take the entire index with it, especially if dealers are delta hedging these moves higher or lower. The second trade is going to be the overcrowded shorting the VIX. We have seen levels of shorting the VIX that we have not seen since Volmageddon and the ETF surrounding the VIX, which is important to understand why the S&P is moving higher consistently. And the third is going to be straight Vanna and Charm decay, leading into every single monthly and quarterly options expiration date in which dealers have to buy back their shorts that they are originally hedging with to offset institutional put buying. This effect grinds the market on top of gamma into every single options expiration date, which is one of the main reasons why the market is moving higher at such a slow grinding speed over the course of the last 3 years. Okay, so first, open interest. You hear a lot of traders talk about open interest on Twitter or Reddit. And this is a way for traders to gauge sentiment on whether a stock is maybe receiving some bullish or bearish momentum at any given moment in time. Open interest and volume were both taken into consideration very heavily during the meme saga, where everybody thought that if GameStop and AMC had a massive open interest or massive volume coming in on the call side, it was going to form a gamma ramp and send these stocks screaming to the moon, which never happened. Now, what open interest is the total amount of outstanding options contracts that remain on the chain, not closed or exercised. And what determines that chain in open interest, which is calculated at the end of every single day, is volume. Now, when you look at options flow and you see a ton of volume come in, whether it's either at the bid, the ask, or the mid, that volume is the total amount of options contracts that was traded today, intra-session. And that is updated in real time as your trading day session continues. So open interest after close, volume updated in real time. The volume is going to contribute to the next day's open interest change. So if you're looking to trade based off open interest alone and you're viewing a chain, strategizing on how to place your options positions based off how much open interest is at any given strike at any given moment, you have to remember that that open interest can change overnight. I've had this happen to me a few times where I had a trade that looked good and I got burned by open interest changing on a Thursday night and my Friday expiration puts got nailed. So just be careful to use open interest and volume as kind of like a confluence measure and not an end-all be-all, as these things can change at the end of every single trading session. As a final visual, I want to show you guys how an active chain actually looks when you're looking at open interest. On this would be the put side. See how there's high open interest leading lower into where the S&P strikes are, which are 655, 653, going all the way down to the lowest strike possible. And you can see the open interest right here growing 116,000, 39,000, 14, 58,000, 27,000, 52,000. So this is how many active open interest contracts are right here on the put side on the December 19th S&P 500 options chain. Contrarily, on the call side, you could see where there's high open interest with the volume. You see with the gray, 30,000, 24,000, 30,000, 54. These act as basically a bracket to hold the market in. If there's high open interest on the call side above, high open interest on the put side below, you can expect the market to trade in a range like so, because both sides act as a magnet of some sorts via delta hedging and gamma hedging. Ideally, if you wanted to trade based off open interest, you're doing one of two things. You're buying calls, hoping the market goes higher. You're buying puts, hoping the market goes lower. Or you're writing to open on the opposite side of those. But to be straightforward with you, high open interest does not mean a stock is going to move in that direction. As you can see on this chain in particular, there's high open interest on both sides, causing the market to kind of bobble in that range. It is only when a big news event or market sequence happens where the market starts aggressively moving in one direction or the other, where that open interest can amplify dealer delta hedging and push the market downward twice as fast as usual, especially if you are in a negative GEX or gamma environment. One of the most crucial things to understand is dealers do not want to pay out this money. They do not want to pay out 20,000 in contracts or 30,000 in contracts on the put side. They do not want to buy shares for 100,000 contracts on the call side. So they make sure when dealer delta hedging is going on to keep the market in a tight space where they basically make more money than the institutions. The market is a pyramid scheme. It will always work that way. You can look at an option chain most of the time and say, oh, there's 53,000 put open interest there. Yeah, the market's probably not going to go below that 670 level because dealers do not want that to fall in the money. To a degree, dealer delta hedging seems like something that would happen organically, but there's something much more sinister going on here with the algorithms that actually control the market, in which they ensure that dealers and the GSIB banks stay at the top of the liquidity hunt and make the most money as possible every single week, every single month, every single quarter. If you're a pension fund and you have $100 billion assets under management, your main focus is to diversify your portfolio across all asset classes. But when it comes to equities, you need your surefire winners, the companies that are growth, the companies that are managed by the smartest CEOs in the country, the companies that are going to give you a consistent return year after year on your investment to make sure that your investors and your clients receive that return as well. The Magnificent Seven trade has been arguably the most lucrative trade going all the way back to the 1990s and the dot-com bubble. Just take a look at NVIDIA's chart since the COVID low, up 4,700%. Is it really in your best interest to bet against that? These 7 to, let's call it 10 stocks are now 35 to 40% of the entire market cap of the S&P. This means that the largest institutions, both domestically and globally, are invested in these stocks because they are going to have the best quarterly earnings returns. We're talking about earnings per share, forward EPS, forward guidance, talking about the AI bubble and how they're going to be included with that, multiple streams of revenue. You're talking about deals that they have with other companies, maybe some in the Magnificent Seven. They talk about new sales that have hit expectations every single quarter since the COVID low. The tech and AI bubble has been driven by the Mag 7 stocks since the COVID low because they were the most reliant products and technology that both institutions and retail could use when everybody was trapped at home and there was a global virus preventing any of us from having physical contact like shopping in retail stores. Tech after COVID was king and it still is king today. So when call buying happens on the Magnificent Seven stocks and the indexes like the S&P or the QQQ, this is a cheap alternative for institutions to invest in the market without buying actual physical shares. And where the actual movement begins is when dealers start to delta hedge those calls bought by institutions because they're taking the opposite side, writing those calls, selling to open. In order to offset that, they have to buy shares of the underlying asset, which pushes both the Magnificent Seven and the indexes higher. Okay, so right here I have your NVIDIA chart with the S&P overlaid in blue. Now, ideally, when institutions are buying calls, like let's say Goldman Sachs or JP Morgan, they're buying in the accumulation phase, which is down here. Okay, they're buying dips with calls in order to make gains if those stocks move higher and the delta on their calls moves closer to 1.0. Now, dealers are on the opposite side of those trades, meaning they are selling to open. They are writing the contract to the institution that is buying the contract. If dealers are writing the contract and they're selling to open on the call side, they have negative delta. In order to offset that negative delta and stay delta neutral, they have to buy shares of the underlying stock, pushing the market higher over and over again. As retail comes in and chases this continuous loop of dealer delta hedging, it further increases the amount of dealer delta hedging that has to happen. Because if retail is buying calls, then dealers are on the opposite side. Dealers have to hedge their negative delta position by buying shares of the underlying, pushing the market up even higher. Simultaneously, there is put writing happening on the Mag 7 and on the indexes. So call buying happens when there are dips. Put writing also happens when there are dips to create a floor. Your put writing levels would be in demand zones, like so. When puts are written by institutions, that is positive delta pressure. Okay, dealers are on the opposite side of that trade. They are the ones buying those puts from institutions, which is negative delta pressure. In order to offset that negative delta pressure, they have to buy shares of the underlying security, which is the Magnificent Seven or the indexes. So on both ends of the trade, you have call buying leading to dealer delta hedging, buying shares, pushing the market higher in order to hedge. You have put writing leading dealer delta hedging to buy shares, pushing the market higher in order for dealers to hedge. These are two majorly bullish scenarios. They happen consistently, especially as liquidity is plush, as long as the Fed and Treasury keep printing money, monetary policy, and issuing debt, which is fiscal. The markets will remain liquid and the repurchase markets will remain plush with cash, allowing a risk-on environment within the equity space. Okay, overcrowded trade number 2. We are going to talk about the shorting of the VIX and the ETFs that run alongside it that coincide with this. This is one of the most crowded trades in the market because, like we spoke about recently, the Fed is printing money, the Treasury is issuing debt, and as long as the repurchase markets stay flush with liquidity, equity markets can proceed to plow higher on the back of solid GDP earnings growth on the back of the Magnificent Seven. As an institution, if you know quantitative easing is coming into the market, you know that one of the best trades around is going to be low volatility. And volatility is how much and how fast an asset's price fluctuates over time. Similarly to delta and gamma when you're talking about options Greeks. Think of it as like the speed and magnitude of an asset's price change at any given moment in time. When the market has plush amounts of liquidity, options are bought aggressively by institutions. This creates not only a dealer delta hedging effect pushing the market higher, but it also creates a positive gamma environment, which is basically an environment in layman's terms where institutions buy dips and sell rips. This pinning of the market allows for a favorable environment for institutions to short vehicles like the VIX and receive a high yield return on their monthly and quarterly options, bets, and hedges. But just remember, and it's incredibly important, that you can't really hedge a timing event. If you as an institution is going to sit there and short the VIX for 4 years, you're basically picking up pennies in front of a steamroller until the market goes in the opposite direction against you, in which the damage to your portfolio can be grave. So let's pull things back first in history to another volatility event that we can actually measure and speak about, which was Volmageddon in 2018. This is where the VIX spiked intraday about 115%, dropped 90% overnight, and then one of the short VIX ETFs was completely disbarred and continued the next day because it structurally broke the VIX, and that ETF had to be removed from the NYSE in full. Remember, Volmageddon wasn't a crash in only stocks, it was a crash in short volatility. So think of stocks and volatility as opposites. As volatility rises, stocks get hit downward. And Wall Street was piling into this trade like it was free yield until it wasn't. To compare the volume numbers of how overcrowded that VIX trade was in February 2018, around 5 billion in shorts piled into the VIX and the VIX ETFs alongside it, compared to where we are now in our current price action, you're looking at something like 70 billion. So 5 billion to 70 billion. You can see how this is a massive problem, but also one of the main reasons functionally and mechanically why the market was able to churn higher from the COVID low all the way into our current price action at 685 in November 2025. And for some visual representation, we are looking at 2008, right where 2009 quantitative easing began. The drop on the VIX when QE began and we turned it to a more risk-on environment with plush amounts of liquidity was from top to bottom all the way to December 2017, basically right before Volmageddon happened in February 2018. You're talking a 91% drop on the VIX, which is the most extreme drop the VIX has ever experienced in its inception. And remember, it only took $5 billion to get there. Now looking at current price and current time, this drop was from the COVID top all the way to where we are roughly now. You're looking at 83% to 87%. And this time, there's over 70 billion in shorts piled onto this trade. Just like the first time this unwinded in Volmageddon and we got this massive rip, structurally breaking the VIX, the same exact thing can happen here leading into next year because of the price of oil spiking, the yen carry trade unwinding. Something like this would decimate the economy. You're talking an S&P drop of over 50%. Okay, now the final most overcrowded trade in the market that I want to discuss isn't overcrowded because of speculation. It's more overcrowded because of systemic and objective handling of diversifying portfolios and hedging when you're a pension fund, insurance firm, or asset manager. This is what we like to call Vanna and Charm decay. Vanna and Charm are two of the subset secondary order Greeks behind Vega and Theta. Vega being volatility, Theta being time decay, which you guys are well aware of. The main difference between Vanna and Vega is Vega measures the price change in your option based off a 1% change in implied volatility. Vanna as a secondary Greek sits behind that and measures your delta change based off a 1% change in underlying volatility. The main distinction you have to take between the two is one is measuring the price change of your option, while the secondary Greek is measuring the change of your delta. And it works the same way with Charm. Theta is measuring the price decay in your option based off how close you're getting to expiration. Charm is measuring the underlying change in your delta based off how close you're getting to expiration. The secondary tier Greeks are there for hedging purposes. These are programmed through various equations telling dealer delta hedging machines how much they need to hedge their delta when the changes in implied volatility or time happen. It's change in your price versus change in your hedge ratio. And if you can remember it like that, it'll be a lot easier to stick. So let's finally review why Vanna and Charm decay happen in the first place. When institutions feel that there is a risk-off environment coming, or equities may not be able to sustain the quarterly, monthly, yearly earnings projections and growth that they have. Institutions start buying puts, which is negative delta. Dealers are writing or selling to open, which is positive delta. To offset their positive delta, they must short the underlying security, which is the S&P 500 in this case. And you would be right to think that that's bearish because, as we know, dealers are the largest institutions in the market. Whichever direction they trade in, they push the market in that direction. So if there's an ample amount of puts being pushed on the market, that would push the market downward. However, that's not exactly what's happening here at all moments in time. You have to remember, as there is ample liquidity in the market, there are also call buyers, there are also put writers. And if the volume of those two trades offset the volume of put buying that's happening from institutions, the dealer delta hedging is going to continue to push the market up into your options expiration dates every single month and every single quarter. And this is amplified via Vanna Charm decay. Now, when institutions buy puts, the dealer is on the opposite side, selling to open or writing the puts to those institutions. The act of writing puts is positive delta. So in order to offset their positive delta, they actively dealer delta hedge, they short the underlying security. Stay with me. As we get closer to options expiration, the puts bought on the institutional side, because the market is not declining past their strike price, are losing value. They're decaying. Their theta decays, Vanna Charm decays, their delta decays, and gamma as well. But on the opposite side of that, the dealers are making more money because they're the ones that wrote the puts, which is positive delta. However, that does not mean that their hedge is making more money. And this is where the buyback effect comes into play. Every minute that goes by that their hedge is losing value, their initial options trade, which they are selling to open, is gaining value because of the elevated amount of calls and puts written on the index, pushing the market up into options expiration dates. So in order to offset the fact that their initial trade is gaining value, but their hedge and their shorting of the market is losing value, they have to buy back those shorts. The act of buying back those shorts is positive delta pressure, pushing the market up into options and quarterly expiration dates, alongside the call buying and put writing happening elsewhere in the market. This effect of dealers buying back their shorts happens roughly from non-farm each month into the third week of each month, which is your options expiration dates. The months that have the most open interest, which is going to be your quarterly and yearly leap months, are going to have the most amplified Vanna Charm dealer delta hedging buyback effect, pushing the market up the most aggressively into those dates because there is more decay on the chain and more shorts that need to be bought back at those moments in time. The Vanna Charm decay effect is arguably the most important thing that you need to know as a new trader, because you'll see the market move on basically no news. And if the market is not grinding up in those 3 weeks aggressively into options expiration dates, you can understand that once that Vanna Charm decay and that dealer flow is absent from the market is completely exposed from that third week into that second week of the next month, which is what we call our window of weakness. Usually when you're looking at the market and you see pullbacks happen, they happen in that dealer flow window of weakness. So just keep an eye on that. If you guys have any questions, I know it can be very hard to understand. Just hit me in the chat. If you guys want to join the Discord, you know where the link's at. Hit me on Twitter. I love you very much. Appreciate your time, and have a great weekend.